Namaste and welcome back to Smart Credit Classes with Sangeeta, where we simplify MSME finance and credit analysis step by step. Whether you are a finance student, banker, credit professional, or MSME entrepreneur, you are in the right place to build your clarity and confidence in finance. Today, we have brought together bankers, finance professionals, and business entrepreneurs because working capital is one thing that connects us all. Whether you are approving a loan, analyzing business health, or running a company, understanding working capital is key to everyday decisions and long term growth. It's the heartbeat of every business, keeping cash flowing, operations running, and opportunities within reach. Now, in this episode, we will understand how working capital assessment step by step with real world examples and practical tips. No matter your background, you will find insights you can use whether you are supporting your consumers, customers, managing risk, or steering your own business to success. So, now grab your chai, pen, and paper, and let's understand how smart working capital management can make a difference for business, banks, and the entire economy. If you are a banker, then this is your daily bread and butter. And if you are an MSME owner, this is the reason why banks often sanction less than what you always request. So let's get started. Now, what is working capital? Working capital is simply the difference between what you own that can quickly turn into cash. That is, you can say your current assets, and what you owe is in the short term is your current liability. So working capital is equal to current asset minus current liabilities, right? Now in my previous video, we have already discussed about what are current asset and current liabilities. Here we will take a quick recap. Current assets example are inventory, your raw material, your work in progress, your finished good, account receivables from whom you need your money is to be coming, okay, your debtors, you can say your cash and bank balance, your short term investment, right? And now current liability examples are account payable, you can say your creditors, short term loans, outstanding expenses, and customer advances, right? We can also put this as working capital means the funds required for day to day business in simple and easy language, right? Now let's move further. Since working capital is equal to current asset minus current liabilities, now what do you think the result, how will it impact? Now think of it as traffic light. If your current asset minus current liability is positive, that we can think is green light, that means your business operations are smooth, right? Because for every rupee you owe, you have a rupee to pay, okay? Now if it's yellow, means suppose if it is zero, then it is a break even point. Here you need to be cautious. And if your current liability is more, that is, if will intend that your current asset minus current liability results in negative value, then this is a very big red alert. This shows your current liabilities are more. The money you owe in the market that is to be paid in short term is more than the asset that you own, right? And now this is a big red alert and you need to take immediate action. Clear? So now next is why bank do care. Why? Now for MSME lending, working capital is critical because business needs fund for raw material, wages, and inventory, right? If you don't have this money to pay for your raw material, your employees, or you can say your labor wages, or for inventory, how will the business run? Repayment of term loans come from the profits, but smooth operation needs working capital support. Easy, right? Now if a working capital cycle breaks, now it will result into delayed check returns, even your account can turn into NPA. Okay, now what is the working capital cycle? Let's understand. this was typical MSME example. Let's say Priya has a pharmaceutical company. It is a packaging company in Bangalore. Okay. Now, first is, if she is starting, she needs to purchase raw material, right? She orders packaging material worth rupees 2 lakh. Supplier payment terms is 30 days. We are clear? Just note it down. Your creditor payment is 30 days. Okay. Now stage 2 is, since she has ordered raw material, now she has got it. Production process. Now here your money is locked. Since you have received 2 lakhs of worth material and now your money is locked, your inventory is in progress, and now your raw material is transforming into finished packaging. Okay. Now stage 3, your raw material has already been transformed into finished good. Now you need customer who can buy it. Okay. Now, since the stage 4 is sales and delivery, your products are sold and delivered. Now suppose you are giving it to you are a wholesale into a wholesale business. Here the payment, the customer, you will receive the payment after 45 days. Okay. Now stage 5 comes your cash collection. After 45 days customer pays, the cycle completes and cash returns to start anew. Since this was a simple one example, so let's calculate our total working capital cycle. 30 days plus 45 is equal to total 75. Now suppose this was a manufacturing unit. This process would have taken another 15 days and it would be equal to 90 days. Okay. Since it is not a manufacturing unit, here only it is a packaging unit, so our working capital cycle is less, that is your 75 days. Yeah. Now you know what, for most MSMEs this operating cycle typically lasts about 90 days. I already told maximum in the case of manufacturing, and sometimes it is more if the raw material or the process takes a more time. It is really very more, and sometimes their debtor also ask for another 30 days, 60 days payment. As the circumstances differ, the working capital cycle increases. Right? In reality, multiple cycle runs simultaneously, and smart working capital management ensures your smooth operation without having cash crunches. Now let's move further. Why is your working capital even important? Sorry, working capital assessment even important? Now let's see. Proper assessment helps avoid borrowing too much, okay, or too little. Too much can ensure cost efficiency, right, and too little will avoid cost crunches. Am I clear? Okay. Now for credit officer, it reduces risk and build a relationship based on trust. And for business owners, it makes day-to-day operations predictable and growth ready. Okay. Now, what are a working capital assessment method? There are 3. First is turnover method, very popularly known as Nayak Committee method. Second is MPBF method, it is known as Tandon Committee method. And the third is cash budget method. Okay, let's move further. Now let's start with turnover method. This method was prescribed by Nayak Committee. Now, Nayak Committee says any business require maximum of working capital is 25% of the estimated turnover. Okay. Now you can say that 25% of the estimated turnover is also considered as current asset or gross working capital. Now this and what amount do banks need to finance? It is 80% of this gross working capital that can be funded by bank. Let's take example, 80% of 25% is equal to 20%. Now how much the margin is remaining is only 5%, because 20% is of 25% is customers margin, and this can be 5%. Okay. That is why after deducting 25 minus 5, it's 20. This is why banks always simply say that we will fund you 20% of the turnover. Okay. Now you will ask why 25% of the turnover is taken. See, 25% of the turnover means 4 cycles. In a year, we have 12 months. 25% means 1/4. Okay. Now this means now 4 cycles of 3 months each. So Nayak Committee assumes that any business can have maximum 3 months of working capital cycle. That is 90 days. Now let's understand this better with an example. Estimated turnover for a business is say 400 lakhs. Now what is the gross working capital required is, let's 400, we will take 400, 25% of 400, it's equal to 100 lakhs. Now how much bank can finance? 80% of the 25%. Okay. Now it is 80 lakhs. And how much margin is required? 5% of the 20% of gross working capital. Okay. That is 20 lakhs. Easy. Okay. Now let's move forward to MPBF method, also known as maximum permissible bank finance. This method was recommended by Tandon Committee. And the MPBF method is a structured way for banks to determine the maximum amount of working capital they can lend to an MSME. Here, credit assessment is linked to level of operations and activity of the enterprises, and it ensures that promoter, or you can say business, is contributing its own fund. That is, it brings its minimum margin to its operation rather than it relies solely on the bank finance. You need to bring your margin amount first. Okay. Now MPBF has 3 methods, particularly method 1, method 2 and method 3. Let's discuss one by one. Now MPBF calculation for method 1 is 75% of straight working capital gap. We discussed. Okay. That is current asset minus current liability. Okay. Borrower margin is 25% of the working capital gap, and here the risk is highest. Okay. Now this is very less used and also considered as outdated. Method 2 is popularly used in banks, and in this MPBF calculation very simple: 75% of your current asset minus other current liability. Now your other current liabilities include current liability minus your bank finance, that is your OD limit. Okay. So 75% of your current asset minus other current liabilities. 25% of the current asset is your margin. And what is risk to bank? Medium. And this is I already told you, most popularly used by the banks. Now next is method 3. MPBF calculation says 75% of your real current asset minus other current liability. The other current liability is similar to method 2, current liability minus bank finance. Okay. Now borrower margin is 25% of the real current asset plus 100% of core current assets. The risk to bank is lowest because margin is more. Okay, and this is rarely used and it is outdated, but conceptually it is important. You need to focus only on the method 2, and you need to understand, because this is only the method used popularly in the banks: your turnover method, MPBF method 2, and your cash budget method. Okay. Now let's take an example. Let's say an MSME has following figures: current asset, that is including your inventory and receivables, of 5 lakhs. Other current liabilities, including your creditors, other payable excluding bank loans, is 2 lakhs. You see, other current liabilities is excluding bank loans, I have already told you. Okay. Now here's how a bank can calculate your MPBF using the most common method, that is method 2 of Tandon Committee. Okay, let's start. Now step 1 is to calculate the working capital gap. Current asset minus other current liabilities, already said. 5 lakh minus 2 lakhs, it's 3 lakh. Now determine the minimum company's contribution. It was 25% of the current asset. Okay. Now what is the current asset? 5 lakh. 25% of 5 lakh, it's 125. Now let's calculate the MPBF method. Working capital minus your minimum contribution. It's 1,75,000. By MPBF method, you can give 1,75,000 maximum loan to the customer. Okay. Now we can move forward. Okay. Next is cash budget method. Now this cash budget method assesses an MSME's working capital needs by forecasting its cash inflows and cash outflows over a specific period. This method focuses on the business actual cash movements rather than its asset and liabilities to identify period of cash surplus and deficit. Okay, it is particularly useful for businesses with seasonal or cyclical operations, as it can pinpoint the exact month when the MSME will face a cash storage and need bank funding. Okay, now what are the steps involved and how does it works? Okay, let's start. First step is forecast the cash receipt, that is your cash inflows. Okay, now the MSME projects all the cash it expects to receive broken down by month. This can include your cash sales, your collection of money owed by customers, income from investment, asset sales or other sources. Okay, it includes all the cash receipt that inflows. Okay, now next step is calculate or forecast your cash payment outflows. Now here the outflows can be your cash purchases, payment to suppliers, salary and wages, operating expenses, like rent, utilities, taxes, debt repayments or any capital expense. Okay, now next is determine net cash flow. For each month the projected cash payment are subtracted from the cash receipt. This will give you the net cash flow. It can be surplus or deficit for that month. Okay, now how you calculate, next step is calculate cumulative cash position. In this method you will close the closing balance from the previous month is carried over as the opening balance for the next month, and the cumulative cash position for each month is calculated by adding the opening balance to the net cash flow. The net cash flow we determined in the step 3 of that month. Okay, now next step is to determine the working capital limit. Now how is it determined? Now the bank identifies the period where the highest cumulative deficit and the peak deficit is among the working capital of the bank needs to fund. I'll explain you this better with an example. Let's start with an example. It will give you a better understanding. Now consider a clothing manufacturer that produces a winter garment. Now sales and cash inflows are high from September to January, but expenses for raw material are highest in the season, where leading to the peak season. Okay, let's start. In July, the opening balance was 50,000. Okay, now cash inflows were only 20,000. In July, very few people purchase winter garments. Okay, and cash outflows, since you have employees, you need to pay rent, that is constant. Okay, so cash outflow was 60,000. Now let's calculate net cash flow. 60,000 minus 20,000 minus 60,000 is minus 40,000. Now what will be the closing balance? Net cash flow plus opening balance. This is 10,000 positive. Working capital is not required. Now let's move to August. The closing balance here moves to here opening balance. Cash inflow, suppose it was 30,000. Cash outflow is 70,000. Now net cash flow will be 30,000 minus 70,000, it's minus 40,000. Now what will be the closing balance? Minus 40 plus 10,000 minus 30,000. Now what is the working capital required? I said negative. The most deficit, the peak deficit is 30,000 for this month. Now this 30,000 minus 30,000 will go as opening balance for September. Now since in September most people start purchasing the winter garments, the cash inflows are good, 1,50,000. cash outflows are less, 50,000. Now let's calculate net cash flow. It is 150 minus 50, it's 1 lakh. Now closing balance again 1 lakh minus 30,000, it's 70,000. Again, since this is positive, working capital is not required. Now let's move to October. The closing balance 70,000 moves to be here to be opening balance 70,000. Now cash inflows are 1,80,000 because it is October, so cash inflows will be higher. Cash outflows decreases here to 45,000. Now net cash flows again 180 minus 45, it's 135, and net cash flow is 135 plus 70, it's 205. So working capital here again required is 0. Okay. Now in this example, the manufacturer experiences a cash deficit in the month of August of 30,000. See, okay, it was driven by high production cost and low pre-season sales. Okay, now the peak deficit is 30,000 in August only. Now using this cash budget method, the bank would sanction a maximum working capital limit of 30,000. Now manufacturer can draw upon the limit only when the deficit occurs. They would need to draw the full 30,000 in August but would not need to use this facility in subsequent months when a cash surplus is projected. Clear? Now let's give you a banker's checklist. As a banker, while assessing working capital, check projections. Are the sales realistic projected by the customer? Verify their stock and receivables with the audit reports. Suppose audit says the stock of 1 CR is present but the customer is giving you 5 CR. Something different, right? You can easily catch it. Ensure receivables are not inflated. Match the working capital limit with the business cycle. Always promote digital transaction for increased eligibility. Tell your customer to increase the digital transaction. You can monitor users of working capital, fund flags, cash withdrawals, and encourage digital use. Educate borrowers on documentation, timely submission, and projection. Periodic review, stock audit, receivables, statement, and account conducts. Always review it. It's not necessary for everyone, but once in 6 months or half yearly you can review, right? Now, next is MSME owners tip. Here's a few tips from me for entrepreneurs how they can make their working capital case stronger. Keep your stock records and aging analysis ready, always ready. Don't overstate your receivable just to increase the limit. Never do that. Show your past turnover trends to justify your projections. Contribute margin money, your share. Bank always expect this from you. Your skin in the game, you can say in simple language. Plan for seasonality. Don't seek permanent limits for seasonal needs. Keep record up to date. Add up digital platform for sales and payments. Understand your cash cycle. Track how fast you can convert your stock into cash. Build credibility with banks. This I have said always. Build your credibility with banks. Avoid default. Disclose real business needs. Now, what are the common mistakes to avoid? For bankers, don't forget to exclude current portion of term loan from working capital. Okay. For MSMEs, don't rely 100% on bank finance. Always keep margin. Always put your skin in the game. For students, don't confuse the gross working capital with net working capital. Always remember liability must be adjusted. Now, to sum up, working capital is the lifeblood of a business. It is not just a calculation in the CMA report, it's truly the lifeline of every business. If it is planned well, business runs smoothly, suppliers are paid on time, and bankers feel confident to extend more credit to you. But if working capital is mismanaged, even a profitable business can collapse under liquidity pressure. Yes. Now for MSME owners, start looking at your receivables, stock and creditors with a banker's eye. And for credit officers, always test projection. Don't just accept any random numbers at the face value of anyone. Always remember this. Profit shows potential, but liquidity decides the survival of the business. If you found this session useful, please do like, share, and subscribe to my channel. And don't forget to drop your question in the comment. I reply personally to help you learn. And please don't forget to watch the earlier parts of the CMA series. Links are in the description. Thanks for watching Smart Gate classes.